right. All right. Welcome back to another episode of the Kansas City Commercial Real Estate Market Pulse. Man, I welcome everyone. It's been great. We've been off for about a week or two. I was on spring break with the family, but I'm excited to kind of be back and kick off this session of the Market Pulse. And like you all know, our goal here is really simple. It's to cut through the noise and give you actionable intelligence on what's actually and really happening in the commercial real estate space, especially here in Kansas City. And today, we're going to be diving into macro level dynamics that you need to be thinking about as property owners, as investors. We're going to talk through capital market shifts. And I couldn't think of a better person to break this down than Matt Jones from Matthews Capital Markets. So, Matthew, let me give you a quick intro real quick. Matt is a skilled professional specializing in commercial real estate financing with a diverse background and a commitment to excellence. Matt brings a unique blend of strategic thinking, leadership, and analytic prowess to his role at Matthews, where he continues to make significant contributions in the capital market sector. How I came across Matt was watching and following Matthews Real Estate, but also reading the capital markets reports that I believe my buddy Jeff, I forget Jeff's last name, he's out of Nashville, I think it's Jeff Ank, said, hey, you want to get this market report, send it over to me. And he did. And I read that and I was hooked. So I was like, I got to get Matt on the show so we can talk about capital markets. But before we get into all the meat and potatoes for that today, I want to give you just a quick chance, Matt, because I always love asking this, how you got into the commercial real estate industry, because a lot of people fall into the industry. And I'd love to hear that kind of story from you.
Yeah, no, for sure. And thank you for having me, Logan. I'm excited to be on today. My first interest in commercial real estate really started my sophomore year of college. I did an internship at Chimera, which is in a mortgage REIT here in New York City. I was a sophomore, like I said, learning the ins and outs of the macro economy. That was during 2019 when the Fed was going through a rate cutting cycle. And, we saw one rate cut while we were actually in that 10-week internship program. Just learning their process, how they underwrite deals, how they look at commercial mortgage-backed securities, how they look at residential mortgage-backed securities, and really just trying to absorb and be a sponge to as much information as possible. And those guys, they did a great job with their portfolio, and a lot of them made, a good chunk of change doing it. So that was my first intro to real estate. I love the tangibility of the asset class. That kind of sparked the interest going forward. Took a couple courses while at Boston College. Just took it from there, joined the financial institutions group at JP Morgan out of college, and, gravitated toward the commercial real estate aspect of it. We service hedge fund clients, private equity clients, commercial real estate clients. And I would just say that the commercial real estate deals that we saw, while more limited than, your typical institution, just because our platform wasn't as robust on the commercial real estate side of things, that's where the interest kind of fell. And then from there, I knew that I wanted to be in the driver's seat in a capital markets role. Spoke with a couple of groups, JLL, CBRE, Newmark, and ultimately landed on Matthews, pitched the dream by Andrew Marcus, who is my senior, who I work with, to build out our New York and East Coast presence on the capital side. And we're building the team out, and was pitched the dream of servicing kind of the middle market CRE space, which has historically been an underserviced in terms of giving that real white glove and tailored approach to things, which is what I was used to doing at JP with our clients. So that's kind of the headline from me.
Absolutely, man. Well, thank you for sharing that. I really appreciate that. Let's get right into it, man. I mean, we're seeing volatility in global markets like we haven't seen since 2020, with tariffs, inflation, monetary policy shifting under a new administration. The macro backdrop is anything but stable. And the flash report that you guys just put out for March, it mentioned that consumer sentiment is at its lowest point in 2.5 years, and equity markets are reacting strongly to Trump's erratic tariff strategies. So I wanted to ask you real quick, how are those macro shifts impacting investor behavior in commercial real estate underwriting and what you're seeing right now?
Yeah, it's tricky. Leading up to the election, every single sponsor and every single investment sales agent at Matthews was dealing with the same objection of, we have to wait to the election,
Yeah, yeah,
what we're going to do to move forward. That was the objection, right? And now we're here, and equity markets saw a big bump after Trump came into office. But as the tariff and protectionist policies have been, rolled out, equity markets have said, well, wait a second, this is actually pretty bad for us. And you've seen valuations kind of dip, and consumer sentiment as a carryover from Q4 of last year, just due to just record high inflation and prices going up, you're seeing, consumers really start to take the brunt of that. So I would say, appetite is still there on the capital side of things. And deals are still getting done from the consumer side of things, but we're still trying to meet in the middle in terms of where deals are at on a cap rate basis.
Yeah, no, that makes sense, and I can second the sentiment from all of the people that I've been working with. Well, we're going to wait till the election. We're going to wait till the election, and now it's over, and that's why I've always said that, like, that's not a good objection to continue to wait, and it potentially could give you an opportunity if other people are taking that same stance and that same approach to go and actually get some things done during those periods of time. As an investment sales broker myself and investor, I have noticed that deals are taking longer, and it takes a lot more work to get them under contract and get them to close, but they are still out there 100%. And look, this is really interesting, right? I mean, we're seeing major volatility, right? We've got the S&P down over 10% in just 5 weeks, officially entering that correction territory, and I think that is being driven by the policy shifts and the tariffs and this unpredictability that could be dragging investor sentiment down. But in turn, it's impacting cap rates and capital allocation across commercial real estate assets. So, I mean, from your seat at Matthews, how are you seeing this show up, right? Trump's tariff policy, S&P down, Dow drops, market reacting more to press conferences than economic data. I mean, how are you seeing this show up in real estate lending in the capital markets right now?
It is definitely an interesting time. The phrase we use, right, and it's slightly crude, but there's blood in the water from our end. And we needed to see some of this correction take place. So jobs data has been lukewarm. Inflation reports have been coming in better and better month over month. And the question becomes, how trustworthy are those data sources?
Sure.
They're revising down jobs reports. We saw an 800,000 job revision in, I think it was either Q4 or Q3 of last year. So, administrations are gonna play with numbers how they will. But that being said, the market doesn't lie, and the S&P dipping the way it did was a flight away from risk assets and into treasuries, and as a result we saw treasury yields come down. And with tariffs getting scheduled to be put in place for April 2nd, the reciprocal quote unquote liberation day, that can have a real impact on where market valuations go and what we see in terms of movement in the treasuries.
Yeah, most definitely. That's a great response to that. Let's keep this moving because, like you mentioned, the market doesn't lie, and we have entered correction territory with the S&P falling just over 10% in 5 weeks. And I think that from this standpoint, I'm not sure necessarily how much this impacts commercial real estate investors, because there's a bifurcated amount of investors who, if you're in real estate, you're not in the stock market, right? But they do think about what is driving the market to be down, right? Which, they're watching these policy statements more than economic indicators, which, that's a stark shift from the norm. So, I mean, in regards to working with institutional investors in the real estate capital markets, how are you seeing this shift kind of play out right now? I mean, is availability of capital, I know we're going to get to each asset class specifically and
Sure.
the lending sources soon. But just generally, one thing that I've talked about a lot on this show and with my clients is, yeah, interest rate is one thing, but the other thing is if you can't go find any debt, which is the largest piece of your capital stack on every real estate deal, regardless, that's what puts brakes on transactions. But as I have been tracking 2022, 2023, 2024, and now coming into 2025, transaction volumes are rebounding, which tells me that some capital is flowing back to the markets.
Yeah, no, I would say more than that. Honestly, we are post MBA, which was in San Diego, the Mortgage Bankers Association, which Matthews attended. We met with, I want to say, around 30 different groups, and every single group was bullish on the amount of capital they were going to deploy this year. They were increasing it over last year, and they were looking for deal flow.
Right.
The question becomes, what spreads and what rates are they charging where investors are willing to take those rates, right? Yeah. Who is being most competitive? Who's underwriting to the last dollar on an LTV basis? Who's sizing to the lowest possible debt yield? And what we've seen is there's this flight from risk assets into treasuries. It's bringing yields down. It's compressing spreads on the lending front, but rates still aren't at the point where, we have people who are reaching out asking for, 5% interest rates, 4% interest. And it's just, we're not there. And right. Post ZIRP, I don't think we're going to see that for some time. Yeah. If you can get a 6% deal right now at the leverage point you want and with the framework you want, you need to run and take it, because we're not seeing 5 handles on rates outside of a few select circumstances. And the other thing I would just add as well is what this chart indicates is, the more uncertainty there is in the market, the more certainty lending institutions will need for the deal.
That's right.
Who's the sponsor? What sort of depository balances are they bringing if it's a bank lending to that group? So, we've seen banks ask for increased deposits up to 10, even 20% of a deal. And, wow. It doesn't make sense for most of our investors, like you said, who are real estate guys and gals who, are trying to put as much leverage on a deal as possible and not keep money in a bank somewhere. So, as the stock market corrects, we have seen yields come down, and that's been good for rates and terms that we're getting. But again, we're struggling to dip below that 4% benchmark that the 5-year Treasury is kind of hovering at right now.
Yeah, I want to double click on one thing that you said there. The more
Sure.
uncertainty in the market, the more certainty that lenders need to see. And I think that is a great takeaway from that statement and that work that you just put forward there for us. I think that is a phenomenal way to be thinking about that. Now, the question becomes on that front that I've got for you is, how do we judge how much uncertainty versus certainty there is in the market? So if we're a real estate investor and we're not in the capital markets on a regular basis, and I want to kind of zoom in to see, how certain, I know there's surveys, I know there's sentiments and all of that, but what are you all looking at to say the certainty versus uncertainty levels out there? I mean, I know there's so many different ways to approach that, but what's your go-to strategy?
That's a great question. The short answer is it's the capital allocators, right? Because they are the ones who are putting out money. If they're saying, hey, we're healthy, we have money to put out, they're healthy, they have money to put out. I take them at their word, and we want to do work with those types of institutions. We've seen, we work with private clients, we work with funds, and we've seen on the fund side of things, people are raising large sums of money to go into various different asset classes. We've seen self-storage funds get raised. We've seen multi-funds get raised. And the beauty of what's happening in America today right now is where traditional banks and credit unions and the traditional institutions are restricting and shriveling and backing away from commercial real estate, private credit has basically come in to subsidize that lending environment. So you have debt funds, you have a different debt fund pops up every single day nowadays. So that capital source, that atypical, traditional capital source, is basically coming into the market and subsidizing, where banks are falling short. And we've been pushing that. That's where specialists in the area like myself and Andrew can really help add value to clients, because it's not just taking you to the local bank down the street. It's taking you to this fund manager who understands your product type, understands the shortcoming of, where that deal isn't a perfect fit for a bank, and getting it executed. The one other thing I would just touch on briefly is regulatory policy. So Scott Bessent, Treasury Secretary, is locked in currently. He met with a group of small banks. I'm not sure where exactly from, but very recently. And the anecdote that he gave was they were saying, well, Bank of America does it this way, does their lending, their depository, their balances this way. Like, this is the regulatory framework we should use. And Scott's remarks were basically, you don't service those types of clients that Bank of America services. You don't have $1 trillion in deposits on your books. Those are regional banks. They do most of the agriculture lending in this country. They do most of the small business lending in this country. They should not be, subject to Basel I, Basel II, some of these more onerous structures that have been put on by the regulatory framework of the past 10, 20 years post GFC, that have really restricted the amount they're able to provide credit to their constituents. So that's the other thing that we kind of keep an eye on, is how friendly is this administration to lending, and we think they're very, very friendly to it.
Yeah, great point there to be made. So if you are trying to find out if there's certainty or uncertainty into the marketplace, you just have to reach out to Matt, as he is talking to the actual capital allocators on a regular basis. One thing we're not covering today, but I know is showing up in the news on a regular basis, and I'm listening to a lot of smart people talk about, is the privatization of Freddie Mac and Fannie Mae. So as you mentioned, regulatory situations that could have a massive impact on real estate just in general. We may have to have you back on to discuss that specifically in the future, Matt.
Yeah, that's a whole other podcast.
Yes, it is. Well, let's zoom out. So since the 2008 recession, the United States has run a persistent trade deficit of over $500 billion annually. And so this longstanding imbalance is kind of one of the core motivations behind the Trump administration's push for tariffs and America First policies. The argument is that we've exported our manufacturing base in return for cheaper goods. So how does this deficit factor into, investor sentiment and even foreign investment sentiment, Matt?
Yeah, I mean, I think this chart says it all, right?
Yeah.
If you want to understand what's going on with tariffs, why now, why today, why is Trump so laser focused on implementing this type of policy? And it's, you can see it right here. We joined NAFTA. Mm-hmm. China gets admitted into the World Trade Organization, and we're off to the races. We offshored a lot of our manufacturing. It's part of the reason for the hollowing out of the middle class in this country. And, as a result of that, we've seen our domestic manufacturing fall. We've seen wage growth stagnate, and we've seen a rise in, partisanship in our politics, and a stagnation in our economy. And as government spending has gone up over the last, 2 administrations, it brought us out of ZIRP and into a period of increased inflation, underlying inflation at least. It's been kind of a domino effect since we've changed our trade policy. In terms of how this affects consumer confidence and consumer sentiment, I would say, as we see the Trump administration put on more tariffs, you're going to see the dollar strengthen. And what that means is they will make U.S. goods more expensive for foreign countries to import. And additionally, it will make imports cheaper on our side. Yeah. So that will fight inflation, right, on our end, but it also increases foreign expenditures to bring in U.S. product, right? So there's a healthy balance there of making sure we don't make the dollar too strong with tariffs and with our trade policies moving forward, because you can see a large capital flight from, some developing countries and economies into the U.S. dollar, and that can have a very negative impact on local economies outside of the United States. But overall, I mean, we want to see this chart, if not reverse, at least stabilize. It can't be this hockey stick forever, because it's just not sustainable.
Right. Well said. Well said, Matt. This is one of my favorite context setting slides. After World War II, Bretton Woods kind of laid the foundation and the groundwork for globalization with United States led free trade and investment. And that lasted for nearly 80 years. And now we're watching a rollback of that system as America reasserts its sovereignty and reassesses its global commitments. And that shift is significant, has significant downstream implications for capital flows, for risk premiums, and for asset pricing. And so how are you and the team advising clients to kind of think about, commercial real estate exposure during this, what I'll call geopolitical realignment?
Yeah. No, it's a very good point. And deglobalization is not a new trend, but I think it's a somewhat misunderstood trend. I don't think it's solely Trump versus the world, and he's the one driving it. The Biden administration implemented a lot of the same policies that the Trump administration did on global trade and foreign relations. Trump has just thrown a magnifying glass on the situation. And what we tell clients, and to be honest, this doesn't really come up in the capital funding, situation and discussion that we have with clients. But the way I would frame it is, if America is getting stronger and focusing inward rather than outward, production, manufacturing, productivity in the United States, right, driven by AI, increased investment, increased foreign investment in manufacturing here, that all helps commercial real estate. That helps bring more product here, more work here. It drives retail sales. So down the line, real estate and hard assets in the U.S. is a great investment, in my opinion. That being said, if you also own stocks, you're saying, well, what about me? And in that case, it's an interesting conversation, right? Yeah. Because the stock market is reacting fairly negatively to what's going on. But what I would just say is, this is not, something that, I'm looking at for, the next 2 years in this administration. This is something that will project out for the next 10 years. Yeah. It is not going to change. The writing is on the wall. How you allocate yourself and your resources in your portfolio should be a reflection of your kind of thesis on where America is going from here and whether or not you're optimistic in the path we're taking.
Yeah. Nicely put. So thinking about the EU's readiness 2030 plan, right, which is their response to kind of the United States retrenchment, with the United States kind of potentially stepping back from NATO and foreign aid, Europe must take on a much bigger defense burden, right? And that's got, I think, bond markets jittery a little bit. I mean, Germany's 10-year bond just surged to 1990s level highs. So, I mean, could this capital kind of rotation towards defense spending shift European capital away from the United States commercial real estate markets?
I'm not an expert in European money coming into the US markets. What I can say is, the United States, what we've basically done is flip the contract on them. And rather than us paying and subsidizing for Ukraine's defense, we are saying Europe needs to take on the brunt of both A, if they're going to fund Ukraine's defense spending, they need to fund it themselves. And B, for NATO, right, they have, I believe we've called for a 5% minimum GDP requirement for NATO allies to spend on defense spending. And what you're seeing in Germany, what you're seeing in the UK is, governments raising that money to send to Ukraine and backfill where the US dropped out of. And as a result, investors are saying, well, hold on, wait a minute. How much money? How much are you going to be printing? How is this going to affect, prices and inflation? And we just got out of this situation, and the US has basically stepped back. And as we continue to withdraw and pull back and reassess all of our, international relations from a sort of a zero-based budgeting standpoint, where it's essentially, what have you done for me lately? Investors in Europe are, going to purchase more bonds and drive those yields higher. And so that's what we've seen the past week in terms of the readiness program. That was basically a snub at America. They basically said, we don't think you're going to be there for us. We need to be ready for Russia to increase their aggression. And we think that Russia is poised to, upscale their offensive in the next 3 to 5 years. And we are not sure that we can count on the security guarantee of the United States anymore.
Yeah. That's probably really tough for a lot of people to even just grasp and understand. But the point that I want to make sure people get is the things that are happening from a policy standpoint absolutely have an impact on commercial real estate because of the capital flows and the changes that could come from the different policies that are created, and not United States, but from a global standpoint. So I think that's really well put. Neither of us are experts on, European monetary policy by any means, but I think it's a great point to be made here. So getting back to, the United States, we've seen solid jobs and inflation numbers. We've got 151,000 jobs added, CPI at 2.8%. And yet the market doesn't really seem to care. Why? Well, I think it's because what we've talked about, policy volatility is, dominating that sentiment. And I think it's a great reminder that macro numbers don't always lead the story. So from your seat, how do investors, how do property owners, parse through this? I mean, are you seeing,
Sure.
capital allocate more cautiously right now, or are they getting back in as the previous rate cuts are increasingly priced in? And we've touched a little bit on that, but I mean, there's, when you look at the data, we're looking at some good numbers here. And so you would think that would be positive, right?
Yeah, no. And I think it has been. Right now we're pricing in 67 basis points of rate cut into the end of Q4 this year.
Okay.
Now, that does not mean that Treasury yields are going to come down 67 basis points.
Sure.
Fed funds and Treasury do not move pari passu. That being said, where these reports are important, I think, is they give us a benchmark, right? So the jobs report came in lukewarm. And sorry, I'm just getting a phone call there. Jobs report came in lukewarm. And what the Trump administration is saying is, look at us. We created 93% of these jobs in the private sector. DOGE is clearly working. Now, what I'm going to be interested in seeing moving forward, especially in the March report that comes out next month, is because that will target the end of February as well as the beginning of March. And I believe USAID and the Department of Education will be in there. And there have been more substantial cuts in the past 30 days than there were from this initial jobs report. So if unemployment spikes up, right, you're going to see some pressure put on the Fed to cut rates quicker than they otherwise wanted to. And Powell has said that he's in no hurry to start cutting rates anytime soon. Yeah. So, yes, we are more focused on the press conferences and the tweets and the tariffs, but at the underlying, financial data that we're looking at right now, markets are strong. We're in no hurry to cut rates, meaning, markets are resilient right now, and capital allocators are still putting out money and hungry to do so. So overall, we're in a very healthy spot. If Trump were to leave the economy alone and not put on any tariffs, I think we would just sit here and we would be fine. But this administration wants rates lower, and they will go through any means necessary, essentially, to get that to happen. So by putting pressure on the Fed with tariffs, with layoffs to government employees, they are putting pressure on a system that isn't really designed to not function off of government spend, government employment, government contracts. And it's going to be a very interesting dynamic in the next 6 months to see where we go from there, because Powell's either going to have to capitulate and cut rates, or market or yields are gonna pop up, and inflation is gonna come back, and then we're back where we started,
Right.
Because of tariffs. So it's sort of a game of chicken right now between Trump and Powell. But we've been there before, and
Sure.
in my opinion, I think Powell will probably either move up his timeline or be data dependent, and that data will show negatively enough, hopefully, ideally, from Trump's perspective, that we move forward with rate cuts.
You've heard it here first. That's awesome analysis right there. Absolutely.
If I had a crystal ball.
Yeah, 100%. Well, here's a wild retail trend. Higher income shoppers are flocking to Dollar General. Consumer confidence is shaky and inflation is pinching. So even well-off households are trading down, right? So what does this mean for, commercial real estate? Well, neighborhood retail, something I'm very familiar with, especially discount and service oriented, could continue to outperform as consumer behavior is evolving. And so, Matt, I'm curious on this front. How are you seeing this trend show up in either buildings that you're financing, seeing tenant and expansion plans, or increased leasing velocity? Are we seeing kind of a bifurcation between luxury and discount right now?
It is very market dependent, retail currently, and it is obviously very tenant dependent. That being said, there are some trends that I would hone in on. Lenders want basically resilient properties, right? Properties that you can't just order whatever it is you're going to buy there off of Amazon.
Sure.
So your big box retailers, your your home goods, your big distributors, warehouses, stuff like that. It's getting looked at less favorably than your grocery anchored tenants and your community centers, your staple centers, your nail salons, hair salons, service providers for non-anchored strips. Retail right now, I personally think, is having a moment. We're seeing the majority of our deal flow currently is retail, right? That being said, a deal in Wisconsin that is shadow anchored by, a big box store and has, some vacancies is looked at very differently than a deal in the Tampa submarket in Florida that, that submarket has no vacancies. Their leasing velocity is really quick. And, that center maybe has one or two vacancies, but, they have a leasing agent and they're going to get those signed up. Those deals get looked at fundamentally differently. Lenders love the Sun Belt right now, just because of, migration trends in the U.S., regulation trends, and, overall what we've seen in the retail markets is, like I said, looking more for that stability, that assurance, right? The lease term is really, really important, especially for anchor tenancy.
Yeah.
And on the discount store side of things, it was interesting to see that data come through, that Dollar General is getting a little bit more foot traffic and a little bit more demand. But overall, we saw that deal go through with Family Dollar today, selling Dollar Tree, selling Family Dollar. So that's a big step in the pharmacy space. Walgreens selling to Sycamore, right? So some of these drugstores and single tenant properties that have a little bit of macro news that's happening that could affect them negatively, lenders are staying away from that. So it becomes a lot more difficult to do that deal. But that being said, it's not impossible. It just depends on what your what your ask is and if it's realistic or not.
Yeah, well put. And I think that location is going to be very important there too, because a lot of these stores are in really, really solid locations. So then it just becomes about basis and what it's going to cost to repurpose that space, and can you find another retailer or different use for that building. Definitely a trend I've been keeping my eye on for sure. All right. Well, we're moving from regulation to strategic reserve, and I think this one's big. I mean, we've moved from kind of a regulatory framework to treating certain assets like, chips, energy, land, and even commodities as strategic reserves. I mean, you got to think about the CHIPS Act, oil independence, food security. And I think for commercial real estate, this means more industrial, data center, and ag land demand, right? Real estate is becoming kind of a strategic asset class in a new way. And so I'm curious to hear kind of, Matt, what your thoughts are on which asset classes do you think are being, or you see being reclassified as strategic by, capital markets, and how are they getting priced differently as a result of that?
No, 100%. And it's a good point about data centers, the need for more power infrastructure in the
Yeah.
United States, especially as we start onshoring chip manufacturing from Taiwan. The strategic Bitcoin reserve executive order is interesting. I don't know whether or not it's going to, have the ripple effects intended in commercial real estate, but where it does really affect things is in the crypto markets.
Yeah.
And it gives the crypto investment community at least a framework. This administration is far more pro crypto than the previous
Sure.
administration.
No doubt.
They're actually getting a framework. They're looking into it. Bessent is interested in stable coins. One of the trends that has been talked about for years is the G7 versus BRICS, and the de-dollarization. As we deglobalize, does the dollar become less important? And with stable coins, to my point about the dollar being as strong as it has been in 40 years, stable coins are only going to drive that accessibility to dollars, right? So as stable coins become a broader part of the American financial ecosystem, what that does is it gives foreign investors an easy access to the United States, in terms of capital supply, in terms of purchasing power, in terms of product. So yeah, 100% farmland to be purchased for data centers. Farmland to be purchased for redevelopment of industrial. I think right now, in terms of what we're seeing in pricing, multifamily is obviously the belle of the ball asset class right now, just given it's stable. There's multiple tenants in a property, so you have less risk from a lender perspective of cash flow, right? There's a critical housing shortage in the U.S. that needs to be addressed. So we're seeing a lot of development deals come through on the multi side, and the tightest spreads are in multifamily. But that being said, the appetite for retail and industrial and storage is incredibly high right now. And I think that's where the strategic element comes in, where like for industrial, right, there is going to be a need for more industrial as we start bringing manufacturing home, and, expect to see a lot more of those bigger deals get done.
Yeah, absolutely. Yep. Couldn't agree more on that front. So let's break this down: capital flow and sources by asset class. Like we just mentioned, multifamily is still the most capitalized sector, but industrial is remaining a close second. Obviously office understandably is at the bottom, though distressed investors are circling, and we have seen some glimmers, especially in your home city of New York City, coming back on the office side. But I mean, I
Yeah.
think this capital stack chart tells us what lenders and equity providers are betting on. So, any surprises on and how capital sources are shifting, and what's also happening with the return of CMBS, or like we mentioned previously, this shadow banking industry and debt funds in certain asset classes.
Yeah, the biggest surprise thus far this year has been almost the return of office and hospitality.
Yeah.
So at MBA, like I said earlier, we met with a bunch of different groups, and almost all of them, I want to say maybe there were a few holdouts that said they weren't, but almost all of them have started, oh, we'll look at an office deal. We'll consider it. We'll look at it again. And that was not the case Q4, Q3 of last year at all. It was a hard no. If it was in the subject header, it was no thanks, we don't want it. Hospitality is, again, like you have that's where I would say you have the larger kind of debt fund institutional money world coming into play.
Sure.
Banks don't really want to lend against hotels in from what I've seen, especially local banks, regional banks, right? There are some bigger players nationally, and it depends state by state. But a lot of the cases that we have and conversations that I have with lenders, they're not interested in hospitality assets right now, or their bucket's full, and that's not coming back online as quickly. But again, for office and hospitality, it depends on the class, right? Office, yep. Class A deals, new construction, you want to see them in a good submarket. Suburban office is not really super attractive anymore. Like that's big in my home state of New Jersey. You're not seeing many suburban office deals get done. You want that Class A product. Hospitality, again, you want, it depends on what flag it's under. Hilton, IHG, some nicer flags are getting the look more from lenders than some of the discount or boutiques. On the multifamily side, again, agency is still fitting into the box. However, their underwriting and their spreads the past few weeks have just been a little less competitive than we would have liked to see. They can get you a deal in the 5s if the product is the right fit. If the deal is agency, it should go agency. But that being said, for smaller properties, in the $1 to $10 million space, Freddie Mac small balance, they've changed requirements post the situation with some of our counterparts in the city, and they're really grilling and looking into the property level and sponsorship information on that front. So it gets trickier to get a deal done with agency on multifamily, and sometimes bank execution or credit union execution works just fine. Retail and industrial, again, having its moment. We think that, retail is going to continue to just thrive, especially as, leasing velocity continues to pick up. People continue to shop and to spend. Hopefully we don't see too much of a pullback in terms of consumer spending. Consumer sentiment is down, so it can happen. But sure. That being said, from the capital standpoint, lenders are interested in putting capital into those deals.
Yeah, I mean, main takeaway for me here is, sources may be shifting, but capital is out there. May have to rethink and recalibrate your expectations on your real estate, financing needs. But it is out there, it is flowing, and deals are getting done. And you need to talk to an expert like Matt, who has all of these different sources that he can bring to the table for you and your real estate project. So, real quick, we got 2 more slides and we got some questions coming in. Markets are divided, right? I mean, are we heading into a shallow recession? I just saw another LinkedIn post about how 60% of CFOs that were surveyed believe a recession is coming, or are we hitting the soft landing? I mean, I think it all hinges on the things that we've been talking about today, right? And this uncertainty is creating kind of 2 camps. One that's waiting to deploy, and the other that's jumping in now to secure that first mover advantage. Where are you seeing conviction right now, Matt, from buyers right now? And where's their kind of hesitancy still prevailing?
We had clients when I worked at JP Morgan who were constantly trying to time the market. And constantly, had millions of dollars to invest into a strategy, into the S&P, into whatever it might be. And even when it was the S&P, right, it was 200 points lower a month ago. It was 300 points lower a month ago. I'm waiting for a 500 point correction. And you could tell them, here's the graph of if you invest lump sum, if you parse it out over a certain number of months or years, your returns end up looking essentially the same. when it comes to conviction, especially for like long-term held assets that you're going to purchase, again, to the point, if the deal works for your numbers, if you are getting positive leverage on a deal and we're getting a rate that you like and a leverage point that you like, take the deal. We do not know where rates are going to go from here. I can tell you that I think the Fed cuts are going to come and that the tariffs aren't going to be as harmful, but that could change tomorrow.
Sure.
We're not sure. Reciprocal tariffs could absolutely send us into a recession. We don't know. That being said, I don't think we've been talking about a soft landing for 2 years now. It gets to the point where it's like, if you've been waiting on the sideline this much, how much brain damage and how much time have you spent underwriting these deals? It's like, you get to the point where you're on your 50th assumption. It's like, either pull the trigger or don't,
Right.
So it's really, not to be crass or overly simplistic about it. But at the end of the day, right, like that's the type of guidance that I'm trying to give, right? A little bit more of an unfettered opinion. I think you can read kind of these puff pieces on CNN and
Sure.
MSNBC and Bloomberg and CNBC and whatnot, about the economy and where we think we're going. If the deal works for you, it works, in my opinion. And we might see rates with a 5 handle on it, in a couple of months. But at the end of the day, right, like if you negotiate well enough and take the right deal, you might have a flexible or no prepayment penalty anyway, and be able to recapitalize and restructure and, get the deal under your belt first, into your fund, on the management side of things, get the value add done, and then talk about the recap on the back end.
Yeah.
That's kind of where we're seeing things.
Absolutely. I think that Dr. Peter Linneman said it best when he said, if you have capital, you have courage, and you have a long-term perspective, it's really hard to lose in commercial real estate. So just keep that in mind as you're working on your projects. Look, Treasury yields have been bouncing. 5-year dip below 4% again recently. That's a strong flight to a safety signal and typically precedes economic slowdown. But it also opens the door for potentially, lower cost borrowing. And for developers, especially dealing with the impacts of tariffs, it's a critical window to lock in debt or to refinance. So, are you seeing more activity on the refinancing side or more on the acquisition side right now, Matt?
Definitely more on the acquisition side,
Okay.
a lot more on the development side, just because you're pricing off of those benchmark rates, right? As the Fed funds come down, so does SOFR. So we're seeing construction prices come down, which is great, because obviously, I think developers are fearful about construction costs, labor costs
Sure.
going up, and adding to that cost basis there. On the refinance side, we had it on the other slide about buy downs, on bigger deals where maybe there was too much leverage taken on, to get to the loan amount that a lot of these funds need to in order to not sell the deal. They are taking CMBS deals where they're buying down the rate 2, 3, 4 points, spending hundreds of thousands of dollars, basically burning equity in the building in order to keep it. And while we don't advise that necessarily, we understand why a lot of groups are doing it. Banks are, done kicking the can down the road, it seems. They might be given a couple more extensions, 6, 12, maybe 18 months here or there for select clients. But at the end of the day, they can go out and make a loan at 6% for that money that you have sitting with them at 3%. So they're done giving you, the extensions on your deal. They need a new valuation. They need a new underwriting. So, pretend and extend. We're starting to get to the point where rates have been higher now for long enough that a lot of those deals are starting to get sold, and they're forced sales because the refinance doesn't really work.
That's right.
On the acquisition side, we are seeing spreads anywhere from 120 to 225 basis points over these treasuries on the best case deals, right? On your life company execution, you're seeing spreads anywhere from 120 to 200. the strongest and best banks for the best clients can get you, a 200 spread over the treasury. And CMBS, it was pricing 275, 250 over, over the past week. It kind of blew out to 270, 275, 300, 325. And again, that's where they come in with the buy down offer, and, you pay a point. You either pay no fee or you pay a couple points and are able to get the rate down, and then hopefully size high enough on the proceeds to get over the hump. But in terms of what we're seeing, definitely more acquisitions, definitely funds deploying capital right now, and a lot of new developments and new construction projects, which is definitely a good thing to see.
Yes, it is.
Because it shows that we're moving in the right direction there, which is awesome.
Absolutely. Absolutely. So much knowledge there. Well, we've got time for about probably 1 to 2 questions here before we wrap up. You've added so much value to our audience here today. Let's take one of these. Since we were talking about, development, construction financing, previously, been tough to come by, right? But are lenders kind of opening back up to kind of spec development, especially in hot sectors like, maybe industrial, multifamily, or even, build for rent? That's a hot trend that I continue to see more and more opportunities in.
Yeah. So build for rent, just to touch briefly there, right? There are maybe 3 or 4 or 5 players in that space that really know what they're doing, and that we have good relationships with, that we would trust taking a client to. And they do spec all day. Right. Those are debt funds. They like that stuff. Right. It depends on the execution, right? For spec industrial, you're seeing debt fund execution anywhere from 500 to 700 basis points over SOFR. Right. So it depends. Again, it depends on the deal. It depends on the market. It depends on the appetite. It's really deal specific. I would say, your typical local bank or regional bank is not doing spec industrial construction.
Right. Yeah, that makes sense. This is a great question, I think, here. We're here as transaction volume is starting to pick up. We are hearing, or this individual is hearing more about off-market and JV style of transactions. And I'm curious, are you seeing a rise in kind of maybe structured equity or recap deals instead of traditional sales to try to get those deals done? Obviously, we both know if you've got debt that is assumable, that isn't a hot commodity for people to try to assume. But if it's not available, I have been a part of and actually seen a couple of these transactions here recently. So, are you guys seeing a rise in those types of transactions?
Definitely a rise in those types of requests. Right. Everyone. Yeah. That's the thing, right? Everyone wants the extra 15 basis points or 10 basis points of leverage that, the JV position or the mezz or pref is going to bring in. But unfortunately, it's just, equity is so tricky. Equity is very personality based. There are controls in the deal. Is the lender okay with taking a second, right? So we ran into a case where we were looking at a shopping center with an assumable CMBS loan, and we were able to, get a mezz deal lined up, and it was just about getting that bank to get comfortable with that second position in place. So there's just certain levers that need to be pulled. Everyone needs to be on the same page, and that capital is going to price, in the 10 to 12% range. There's probably going to be, maybe some points in there, some yield that the equity provider is going to want, some preferential treatment in the stack. Like there's different ways to negotiate and manage that based on what fund you're bringing in and the deal size. But again, it's so deal dependent, and it really matters who the senior is, because if the senior isn't cool with it, then it's not happening.
Absolutely. Okay. I got to ask this one. Somebody wants to know, what's the one trend or shift happening behind the scenes in capital markets right now that most people aren't talking about, but should be?
Oh man.
Yeah, that's a good one. That's a really good question.
Man. I would say agency underwriting.
Okay.
It is a nightmare right now. They are taking they are doing a colonoscopy of your
Mhm.
deal. They are going into the property level. They are going into the sponsorship level. They want to understand everything about the last 4 years of operations. We get multifamily deals sent to us, and right, we understand what's going on. We understand that there's certain top item levels in that P&L that are being written off on a tax basis, but shouldn't be considered on an operating income basis. So writing those back, but adding those back to the NOI of the building is something we're tasked with helping clients do. That being said, you have to make sure that you're portraying the deal as fairly and as accurately as possible. And the agencies post Meridian have really, really cracked down on that.
Yeah.
And they've cracked down on capital markets involvement in like brokers involvement in that process. Right. So, our processing team that's based out of Phoenix that helps us close all of our deals once we get them signed up, they're hands off, right? We have to be hands off. The group that's helping originate the deal with Fannie or Freddie, they have to be hands off. So it's almost like the buyer needs to know before going into the deal how to best present it. And obviously we try to coach them and do as much as we can to try and help them get that deal across the finish line. But it's just really tough, and they've really kind of tightened the grip and made those guidelines.
Well, I think that we may have lost Matt there just for a second, but he had a great response to the last thing. The idea of commercial real estate underwriting on the agency side being really difficult right now. Matt, we covered a lot of ground today. We went from capital markets, we went to a global macro economic standpoint, and all the way back now to each specific asset class. If you're interested in connecting with Matt, find him at Matthews Capital Markets. He's easy to connect with on LinkedIn as well. We really appreciate you being here. We'll be back in a few weeks to cover our next guest. So thank you for joining us here at the Kansas City Market Pulse. We're very excited to continue to bring you the top of the market and most up-to-date information on commercial real estate. And we will see you next time.